Thanks, Fred. Our next speaker this morning is Tom Stevens. Tom is a senior manager in the San Diego Business Tax Services practice of Deloitte. He advises foreign and domestic energy clients regarding tax issues related to wind, solar, biomass, geothermal, and other renewable energy projects, including tax credit monetization and due diligence. Tom serves as the lead tax advisor in some of the leading United States renewable energy project financings and developers. Today, Tom will provide us an overview of the available federal tax credits and incentives for renewable energy products, including the monetization structures for certain tax attributes. Tom?
Flip this on. Thank you very much, Sue. Well, Dwayne was right on when he talked about the importance of Washington in clean tech and renewable energy finance. With Congress likes to either discourage certain activities through the tax code or encourage certain activities through the tax code. So they use a lot of tax credits to incentivize certain activities. For example, research and development. So the technology companies that are here, you're doing a lot of R&D, trying to improve on processes, technologies. Our research and development tax credit's been around for a long time to help subsidize some of those expenditures through tax credits and also deductibility provision. The challenge with a lot of these tax credits, though, especially from a startup standpoint, is that you get tax credits, you claim them on your tax return, but how do you convert those to cash? And so, well-established companies where maybe they have an R&D division, but they have other lines of business generating a lot of taxable income, that's not a problem. Flows through, reduces their taxes, cash savings. From a startup company standpoint, the challenge is, okay, I'm being given these tax benefits, how do I actually use them? How do I convert them to cash? R&D credits is an area where sometimes it's a challenge. I had a client in 2005 developed a prototype utility scale wind turbine, brought it to commercial development, built out production in Iowa, generated millions of dollars of R&D credits. They did an IPO during that sort of 06 timeframe, and they still haven't been able to use those research and development tax credits. So that's really critical. From a project standpoint, there are other credits like investment tax credits, production tax credits, that if you don't monetize those credits, the deal just doesn't pencil out. And so some of what Dirk was alluding to as far as the tax credit monetization structures evolved because tax benefits are so central to making the project pencil out that you have to bring in somebody to use those. The provision that Dirk was alluding to about as part of the stimulus to provide grants in lieu of some of these tax credits was a direct response to the lack of tax capacity as part of the financial crisis, where some of these large investment banks, commercial banks, insurance companies that were investing and utilizing the tax benefits, their tax capacity evaporated in the financial crisis, and so projects just were not going to get built. So the Stimulus Act instituted these temporary measures to basically allow people to say, okay, in lieu of this tax credit you're going to give me, I want an actual check. So, we encourage research and development. Investment tax credits are used for project developing renewable energy generation, like a solar project. Also, as part of the stimulus, there was an advanced energy project credit, which was more intended to stimulate domestic manufacturing. So you would get a 30% investment tax credit if you went out and bought equipment that was used to manufacture, say, a solar panel or a wind turbine blade. That was oversubscribed and would need to get extended beyond that. There's also a Section 48D, which was a therapeutic discovery project credit, which a lot of San Diego companies were able to avail themselves of. And that was after the first round of the advanced energy credit, they figured out we're giving all these startups a bunch of credits they can't use. We need to have this grant provision so that they can actually turn it into cash. And so the 48D provision actually had that ability. So as these are extended, I think there's a lot of lobbying saying, well, okay, we're startups, we need to be able to monetize these. There's also production tax credits based upon renewable energy generation. I'll get into some more details on some of these as well. And then the 1603 grant, which Dirk alluded to, which is basically the equivalent of an investment tax credit. So if you go out and spend $100 to construct a solar facility, 90-some% of that's going to be eligible basis. You get $30 of a grant. And there's a whole process to apply for it. There's independent accountant certifications that we're involved in to support the application. And then there's also, they're encouraging economic development in distressed areas. So there's new markets tax credits that sometimes you can combine with some of these other incentives and avoid some double dip provisions. There's employment credits for companies that are locating their manufacturing operations and they're hiring a workforce. There's also incentives to consider there, as well as alternative fuels for biomass. So there's different excise tax credits that are applicable. So there's, as you can see, there's just a myriad of federal, and then on top of that, there are a bunch of state incentives that you have to factor in. Some other ones are conservation, so energy efficiency. If companies go out and improve efficiency, you can accelerate tax deductions. Some of the incentives are also intended to stimulate demand. So you have tax credits for plug-in hybrid vehicles. Those are intended to get consumers, interested in buying those products. My background and client base is primarily renewable energy generation companies, and so I'm going to talk about a lot of those incentives, which are primarily that grant that we talked about, which is basically in lieu of the investment tax credit and production tax credit. So if you're going to go out and build a solar facility, wind facility, geothermal, biomass, and build your pro forma to figure out how much can we bid to make this project pencil out, these tax incentives are going to be roughly, if you look at a 30% investment tax credit on top of accelerated depreciation, so there's a big time by money benefit on these capital intensive projects by getting accelerated tax depreciation or potentially bonus depreciation, which is a provision that's applicable now, either 100% this year or 50% next year. So you basically, you build a pro forma. The tax incentives are really critical to that. Here's a quick kind of overview of the various ones. I don't have enough time today to go into all the intricacies of them, but I'll preview it as part of the panel if we want to dig into any of these or talk to me afterwards. The production tax credit's been around since the early 90s. That's basically an incentive based upon how many kilowatt hours are produced for a 10-year period from original place in service. So if you go out and construct a wind farm, you would get this production-based incentive. Investment tax credit's been around in various forms before that, in the 80s. And basically it's, you make a certain eligible investment, you get a certain percentage of it back in the form of a tax credit. For solar facilities, it's a 30% investment tax credit. Certain other ones, it's 10%. Because it's a big upfront incentive, there are different recapture provisions that have to be considered. It basically vests 20% a year over 5 years.